New this morning, Anthony Pompliano is here, and he is taking a blank check company public right here on the Nasdaq. It's going to list under the ticker PCAPU. Joining us right now, first on CNBC, is the man himself, Anthony Pompliano, CEO of Professional Capital Management. And they're saying SPACs are back, sir. So this is a SPAC. SPAC's got a bad name, though, I was going to say, and we're going to talk about all of this in a moment, but I want to bring in one other member of this partnership of sorts, Brent Saunders, who we haven't seen in a long time. Brent, chairman and CEO of Bausch Lomb, who's special advisor to this special purpose acquisition company. Good morning to you as well.
Good to see you, Andrew.
So take us sort of back. What is this SPAC going to do? And most importantly, why are you pursuing this now? Given there was a lot of hesitation about SPACs. Obviously, it's sort of the last vintage of them. And what's the difference?
Yeah, look, I've got a very large audience online. Bankers have been pitching me for the last 5 years to do a SPAC, do an RTO, do whatever kind of public market mechanism. And frankly, I didn't see the demand from the private market. That all changed about 6 months ago. I think part of it is that there was a political change. There's a regulatory change specifically in financial services where I think people see it as a tailwind, not a headwind anymore. And then I also think a lot of companies that were started between 2015 and 2020, they're now reaching the maturity point where they can be a public company. And so based on that inbound demand that I started to see, I called Brent. Brent and I have been friends for several years now. He's a shareholder in our investment firm. And I basically said, look, you're the best guy I know at doing this. You've got the most experience.
Right.
You know, he's done $300 billion of acquisitions. And I said, help me figure this out. And we decided to do it together.
So, Brent, what kind of stuff would you want to buy? Just to sort of give us, I know you're not allowed to say a specific name, but sort of in the vein of.
Yeah, so look, I'm an advisor. I think that Anthony has consistently demonstrated a forward-thinking approach to investing in transformative technologies and fintech, and I think our focus, or Anthony's focus, is really going to be on fintech, financial services, and looking for places where he can really use his media presence to amplify the visibility of the potential target. So it's a really nice combination, and someone I just have great admiration for, and someone I thought I could help with a lot of hard-learned lessons over 17 years of being a public company CEO.
In the most transparent way possible, explain the economics for the sponsor. And I just want to context and caveat this by saying one of the reasons why I think SPACs got a bad name during the last vintage was because a lot of the sponsors made an enormous amount of money, but unfortunately, the shareholders did not. Yeah. And I don't think that everybody fundamentally understood exactly how the economics played out for everybody.
Yeah, it's a great question. I think there's two major points here, right? The first thing is a lot of the reason why SPACs got a bad name is because people basically were doing public venture capital. They were buying companies that were losing lots of money at high prices, and they were crossing their fingers and hoping that those companies grew into the valuations. Some did do that, but a lot of them didn't. And so naturally, if you put a company that's losing a lot of money at a high valuation in the public market investors are smart and they hammer the company. I think what we're really focused on is being super disciplined and buying a cash flow positive business that still has all the right criteria that you want in terms of high growth potential and good team. But if you do a good deal at a good price, it doesn't matter who the sponsor is. The company should do well in the public markets, and that's ultimately what we're trying to do.
Okay, but how much will you make?
Yeah, in terms of the economics, the way that this works is the sponsor at different price points is putting capital in at different share prices. When it prices at $10 a share, right. If the share price obviously goes up, everyone, including the shareholders, makes money. Now, if the share price goes down, the sponsor can still make money. But I think that one of the things that Brent and I both have looked at this is, for me, the capital that I'm putting at risk here, right? Our investment firm's putting millions of dollars into this. And so we've got real skin in the game in terms of that. But I'm taking huge reputation risk with this. And so one thing that I've been very clear with folks is I cannot be a SPAC sponsor that does a deal, sells the shares, and goes and does another one, right? If my reputation's on this, I've got to be able to not only go and do a good deal at a good price, I also have to be able to help build that company for the long run and create shareholder value. And so it's really the reputation risk, I think, is probably the biggest thing that I'm focused on.
But just straight on the numbers. Yeah. Let's say it's $10 a share.
Yep.
You capture, let's not forget about it going up. Let's just say it stays at $10 a share. Mm-hmm. You capture how much of that?
Well, if you think of how much money, so we've put $5 million into the, us and investors, $5 million into the risk capital of that. That obviously today is $50 million as the pricing.
So you're 5 of the 50.
Well, $5 million is what was invested in terms of that. Now, our investment firm didn't do all $5 million of it, but we've put a significant amount in. And then from there, if the share price goes up, obviously we can make money. If the share price goes down, obviously we can lose money of that. But I do think...
Are you collecting 10% of the business? Are you collecting less than that? Let's just...
It depends on the size of the business that we go and we buy, right? So if you go in, there are deals that I think people have done where they've tried to buy, more than 50% of a company. There's deals that people have gone and they've said, hey, I want to actually just buy 5% of this business. And so we've got a $250 million SPAC. What's interesting, I think, is, when we went out,
Shouldn't you be able to... I'm sorry to push you on
No,
this.
go ahead. No,
Shouldn't you be able to say if it's a $250 million SPAC and the price doesn't go down and just to stay static, I think you should be able to tell the audience right now, I will own X amount of that $250 million.
Well, the way to think about the $250 million is going to go to buy another company.
I understand.
Right? And at that post-transaction equity ownership, we don't know how big the other company is.
I understand that, but of the 250, how much of that would therefore go to you?
If I could interrupt, I think the issue is it's hard to pinpoint that because you'll raise a pipe, you may dilute yourself again.
100%. Right? I'm saying, let's say there's no pipe. I just think people need to. Look, I think one of the problems that people have with SPACs or that they don't understand is they don't understand the economics because the answers, and I agree, they're complicated answers, but I think we should be able to break them down in a very sort of simplistic way and say, okay, assume there's no pipe, assume this, let's just assume there's $250 million. That's what we have. And we can say if it's 500, it's a different number. But we should be able to. And by the way, I think that one of the disclosure transparency issues for all of these SPACs is there should be a chart that says to the investor, if it's this, it's this. If it's this, it's this. So we have some ranges and people understand how much of the business you will ultimately capture. Is it 20%? Is it 10%? Is it 5%? What are we really talking about?
To be fair, Andrew, there will be some range, whether it's 5% or 15%. You won't know till you do the deal. And to be fair, at that point, it is disclosed to the investors. And the reason you tend to do a pipe is to bring that transparency and negotiation with the other investors. And that is the time you actually know the economics. Launching the IPO of the SPAC, it's almost impossible to tell you what the economics are till you actually do the deal. And frankly, if Pomp doesn't do a deal, he loses all his money.
That's true, yes. Let me ask you a separate question. Okay. One of the other sort of issues around SPACs has been that there are these forward projections, right? Forward projections is something typically in an IPO you historically couldn't do. A lot of companies were making, because it was a merger, they could claim they were buying the company and then tell you what they thought the business would be worth 3 years and 5 years later. Having said that, the sponsor typically was not attached to those future. They didn't have to. It wasn't like they were vesting on the 3 and 5 years. They were oftentimes, depending on the transaction, I want to say in the fine print, but you really had to read pretty carefully and do like your own math and understand. Okay, if it stays at this average, within 12 months they could be out. Yeah. What is your plan as it relates to whatever deal you do in terms of how long you're in?
Yeah. So I think if we take a step back here for a second, we went out with a $200 million SPAC. BTIG, which was the exclusive book runner on this deal, told us yesterday that there was 1.7 or approximately $1.8 billion of demand. And so approximately 9x oversubscribed. And I think one of the reasons why a lot of these institutions, in my opinion, are excited about this is because we're very focused on being disciplined on the valuation of the company that we buy. We think that there are some unique advantages that we bring to the table where companies will want to transact with us at a very fair valuation. And then on top of that, again, it goes back to I'm going to be involved in the business moving forward. This is not a do the transaction and walk away. And so anytime that you do that, obviously, I don't want to buy a company that sells me, the sky and all of a sudden doesn't deliver on it. And so I do think that there is a potential economic misalignment if people are just doing this to essentially bring companies into the public market and walk away. I think a huge part of going back to what are we trying to do here is this idea of discipline, being disciplined on the company you buy, being disciplined on the valuation you buy, and then also being disciplined on the idea of trying to build an actual business post-transaction.